And that means we are now live here on our YouTube channel. It's our daily show we call the Halftime Report, where we go through the news in the market, the charts in the market, the price action in the market, economic data, anything that's impacting the market, break it all down, give you guys some analysis from the coaches here at Tackle Trading so you can better run your daily routine as a trader. And welcome back to our community. By the way, got some new subscribers here. We're barreling towards that 20K mark, an artificial number that I think is important, but really isn't, Matt, but kind of is. And I think it's really cool when we're going to get there. So we're going to celebrate it because I set it as a goal. And that's pretty much the only reason. How are you doing today, sir?
I'm doing very fantastic. I'm excited to be here with the crew.
I am as well. And Greg, welcome back. Fun competition last night. I'm not going to trash talk. You have every right to have won that event.
Your way of trash talking.
I feel like I just got backhanded by Tim Justice.
You absolutely did.
You know, the contestants were both prepared and ready. I thought it was a fun, a lively event. Could have gone down to the wire, no doubt about it. I did sneak out the win, Greg. And by the way, the reason I bring it up is not to brag. I just had a blast. I had never had a chance to be on Trade Masters. I know you've done that a lot, Greg. It's a really cool format. I can see why the audience and the community likes it, man. Thanks for being a part of that with me last night.
Yeah, it was fun. It was a good time. I think it was closer than the results showed, and I think everybody enjoyed it. So I definitely think I won the joke part, but that's just that's opinion based too. So
I gave you a beating. Let's not call it.
Oh, come on. Your dad jokes didn't even get off the ground. Come on.
I had some good jokes, actually.
How'd they go over with your kids, Tim? That's what we want to know.
Oh.
They didn't laugh.
No. There you go.
That's the question. They weren't that funny. Matt, I know you were watching the show a little bit last night. We had fun with it. Yeah,
I was a participant, as fair and balanced and transparent. I thought Greg won Delta. I did. I voted for Greg on Delta. I voted for Tim on Theta. Didn't vote for the last one. I had a run on the wild card round, but. I am looking forward to eventually sitting in Discord with some of the pro members of Tackle Trading as we watch Trade Masters together, because I think it might be fairly entertaining to listen to my commentary as you guys break down your picks. I was on with my son Tanyan last night, and we were just kind of chatting while you guys were going about it. And I was analyzing both of your guys' picks in the real time as you guys were teaching in Trade Masters. And oh man, I had Tanyan rolling, so maybe I'll get on Discord with some of the community, and we can have some fun watching Trade Masters together.
You could even start live tweeting about it. You can get your thoughts.
No, just Discord.
Discord.
My thoughts on the coaches during Trade Masters will be a Tackle Pro, not out there for public.
That's too funny. I actually would enjoy that. I would enjoy that. Not when I'm the guy being talked about. No. I'm not talking about when I'm on. I'm talking about I would enjoy it
when somebody else.
Somebody else is on for sure. If you didn't get a chance to watch
what that also means is I can't ever be a contestant on Trade Masters, or I'll get payback big time.
That is a pretty funny idea, actually. I think we could do something like that. By the way, real quick, couple things as we're getting started. If you ever miss any of our content on our YouTube channel, you can find them in our playlist in our video archive. Go back and watch last night's show. And as we're coming in today, we got a busy show to get right down to business for. So do me a quick favor, give me a thumbs up. Click that subscribe button, click the bell, and let's light it up here. Matt, we've been watching intraday levels all week, and the reversal characteristics. We started the conversation really several weeks ago as we were trying to find some bottoming action in the S&P 500 on the pullback. Last week, we saw some support hold around 4260. Coming into Monday, we even had a podcast on reversal characteristics. You described the nature of them, and here we are. We did break one of the levels you identified for me, 42 or 4360 on the S&P
4360 by 70, yeah.
And then now we're pushing towards that second level, which is 4430. What is your read here on the market? Because a lot of this stuff is playing out the way that you were mapping it out for us over the last couple of weeks.
Well, honestly, we try to come into Tackle every single week, and in the Skyline report meeting, we're reading the markets, we're building those reports, we're preparing for our newsletter, but we're also trying to figure out what is the most relevant information we can provide our community on a daily basis during these moments of volatility and moments of doubt and moments of concern. And so I felt like the market was showing reversal characteristics, and I just felt like We needed to spend a little bit more time on really hammering in, those reversal type scenarios. And you saw that play out this week. Now, we are not out of the woods yet. We still got a major, major resistance level that we are fighting up against right now. I'll get into that here in just 1 second. But you do got to like the resiliency of the marketplace over the course of the last few days. As you're coming in, you see this neutral range start to occur. The backdrop, you have a nice little downtrend coming in, pretty volatile, nice little downtrend. But then you see that support level start to really firm up, as we discussed yesterday, with a very volatile cash open, but yet support holds here. That's a positive data point. And throughout yesterday, you just kept fighting. You just kept fighting, and it wasn't clean. It wasn't clean at all yesterday. It was just a battle yesterday as you fought back up into those resistance levels, and it had a fairly positive final moment in the market. And then on the overnight action, you see it kind of punching up, punching up, punching up. And then as you start to get into the pre-European market hours, right when the Frankfurt German ECB bank opens up, you start to see that power come in on the 9, and it just rides the lightning. Here's the cash open today, yet another positive cash open today. That propelled the market up even higher. And even though, there's something happening in the market to a certain extent, because when you look at the bank's earnings today, and more than anything, I'm talking about the price response, not a lot of fantastic price responses. But you're seeing a collective mentality out there in the market participants right now that earnings so far, even though we haven't seen those blow off tops in the financial sector, earnings so far are coming in better than anticipated. Sales growth coming in a little bit better than anticipated. Most companies have done beats and beats. And even though we haven't seen a lot of guidance so far, the financial banks, remember, this is financial week, the banks don't provide guidance. And so we're not going to really start seeing those guidance numbers come in until we get into some of the materials and industrial components, some of those tech components, some of the comms, and that gets a little further into earnings. So I do think the market participants are in a little bit of a buy the dip mode, and they are proving here on the overnight action that they were willing to pay a higher price. On the cash open, they're willing to pay a higher price, and even on throughout today, they're willing to pay a higher price. And I've said this for the last week and a half. Those swing traders out there, those position traders out there, those two excuse me, those two styles of traders are very similar to one another. And before they can start getting the confidence to carry trades overnight, they got to start seeing some of this intraday analysis really firm up. And that's what we're seeing here today. You're seeing the breakout on the overnight action, the continuation on the US banking hours, the cash open. All of them had positive responses to the market, and that has propelled the market into a resistance level that is extremely important for the market, and we know that's right there in the 50-day moving average. Let's see how that behaves at that 50. But remember, and again, Tim, how many days? How many days?
Dude, that epic
how many
pen,
days?
Listen, I'm not going to complain. I love the epic pen.
I know, but
it could be every
days
it could be every day for the rest of the halftime report. I love the epic pen.
Remember, I did a Matt's whiteboard for the step system yesterday. And I was talking about V-shaped recoveries.
Look at that. Yeah.
That's what a V-shaped recovery kind of looks like. It has a little bit of a head and shoulders feel to it as well, but the head and shoulders and V for victory, as I discussed in the video yesterday, doesn't really have a momentum shift to it for the V shape. And so there is some commonality there, but I'm seeing reversal characteristics. I don't feel we're going to just break through and just sky. I think there's a battle here, but it's a positive battle that the bulls are willing to pay a higher price. And I think that's a positive development for the marketplace.
And keep that visual up for just a minute. I'm loving the conversation so far, and I want to get Greg's thoughts here in just a moment. But as you were talking about bank earnings, responses to earnings, it really made me want to go dig up something because I thought it was a really, really good point. But that visual, though, I think I got to point something out here. It's those pivot points. I've been talking pivot points all week. It's the pivot point relationships where true understanding of this concept comes in. And I love the way that you visually drawn that, Matt, because we do have that higher pivot low, which is where the analysis has been all week long. We found intraday support. We've now fired off, and we're pushing for a potential breakout here. But back on the bank earnings response, because that's all happening on a week where you would assume the headline is bank earnings are great and the markets are up. That's not what's happening right now.
Mm-mm.
In fact, look at, and we'll get to the numbers on bank earnings later in Stock Talk. That's not what I want to do right now. But look at the responses the last couple of days. Just flash fire through them with me if you can.
Yeah.
JP Morgan, okay. Muted response. They came out, they had great trading revenue, all kinds of stuff. Mixed data though. They had write downs, came back down. Now it's fighting for the 50 period moving average. That's not why the market's pushing resistance. Bank of America today, sure, nice response out of Bank of America, but it's up what, like 3%, pushing resistance level. Wells Fargo on the same day is down 2%. Morgan Stanley's up 1.9%. These are all companies who reported this week. Citigroup is flat, doing nothing, literally on a doji in the range. So you can't point. USB, another bank, down 3% that reported this week. So the narrative of the market is not strong bank earnings, so the markets are rallying. The market is just naturally improving through the technical conditions, Matt, which is actually, for me, an even stronger technical read. What about you? Is that kind of why you've been paying attention to those bank responses? Because I thought it was a really good point you brought up.
I thought the bank's earnings were fine today, and I'll go through the numbers one by one, but we saw a lot of beats and a lot of beats today from a bank earnings, and EPS numbers, revenue numbers were perfectly fine. And again, the banks don't provide guidance. And most of these price movements, whether they were up or down, they were within the ranges. And so remember, we're going to take Apple, for example. Apple, #1 company in the world, but it also has a very consistent, this $2 trillion juggernaut has a very consistent 5% type movement on earnings. And so the market maker is always going to price in some degree of 4 to 5% movement up or down. And whenever a stock moves within the range on an earnings, we don't, even if that's up or if that's down, if it's within the range, we're not going to be too concerned about that. And so yes, you are seeing a little bit of a muted response to earnings, especially within those earnings reports like JP Morgan, like Morgan Stanley, and so on and so forth. But I do think over the last 24 hours, the market's giving a little bit of a tell here as they started, despite some of these banks coming down here today, the market started building the strength from an intraday perspective. And you had that combination of events occur where I do believe that there's, and again, around earnings, there's a lot of things that could happen. Hedge funds, institutions could pre-plan selling before we eat, like months in advance. And so, and that's why if it's within the market maker move, we're not going to get too caught up into that. So I don't concern myself too much with the downward movement in the price in some of the banks, because you take a look at JP Morgan, man, that's a bullish retracement with a hammer candle and an inside candle called a bullish harami.
Trying to find support.
Right. That's trying to find a nice support range around 160. And so these downward moves in price, a lot of times, even if they're on the backs of some positive earnings, a lot of times I just kind of see that as pre-planned selling. Somebody said something stupid, give the market a little bit of a moment, let it find support, and then let's rock and roll. But in terms of the market over the last 24 hours, you do see this consistency in from a technical perspective. And so, and again, I'll go to the weekly chart here in a second, but you do see this consistency in this chart starting to build. And even though you've had some of those banks, that cash open today, which is all the banks, that Wells Fargo you're talking about, that coming down, that all those banks, and yet that cash open was strong. Because the cash open, all of a sudden, you have a positive catalyst. Traders start seeing a little bit differently. The context, the perception changes a little bit. You're starting to build into that. And then all of a sudden, you get some labor market news, and nobody cares about initial claims. Like, nobody cares about it.
Oh, come on.
Let me say it again.
Come on. I can make it sound important.
Let me say it again.
All right.
Nobody on Wall Street actually cares about initial claims right now. So why today is everybody like, oh man, did you see the initial claims? Did you see? Oh man, market's going up. No, it's the confidence of the market building as market participants start dipping their toe in. It becomes successful. They start dipping their toe a little bit more. Momentum builds. Has little little to do with initial claims.
Well, give me a 5-minute chart on that, because there's some timing to this that people need to understand. You're 100% right. The reason the market is pushing resistance is not because of the initial claims data. We did start taking off at 6:30. That's the cash open on the West Coast. Matt's a West Coast guy. 5:30 in the morning, which is when the mark right there on that 5 mark, those times are when those data points came out on PPI
Market
and
did
initial
not
claims.
care.
Market didn't care. The market started trending upward in the middle of the night on the German economic open or the German market open, those type of things. And really, it's just in general strength as bulls are coming back in and bears are getting stopped out. You know, you have a sentiment.
That's initial claims.
That's not why the market.
That's initial claims.
That's right.
But again, it's building confidence by market participants. And now you're seeing the consolidation. Let's go back out to a little bit more technicals here. Once again, the daily. I'm looking at that 50. And again, this is building here. Think Bitcoin for a second, guys. Like, just think Bitcoin for a second here. Let's go to Bitcoin. Look at this. Lower low, lower high, lower low, lower high, slightly lower high. Excuse me, slightly increase in support from 4,000 to 41,000. I would say that's within the range. But visually, just look at this. Once it broke out, reclaimed all the moving averages, it started building. It started building. You come back to the ES. Lower low, lower high, lower low, lower high. Oh, that's a slight increase from that support level. Oh, that looks very familiar with some of those breakout patterns we've seen in the past. Now we just got to start building. Got to see some. And so you do have intraday confirmation. Now we got to see daily. But again, I think the confidence is building out there.
The confidence, the argument, the thesis, it is building, and we're seeing it carry through here today with a 1.5% gain on the S&P. Greg,
again, I don't expect a Bitcoin 4 bars later we're kissing 4,600 here in the S&P. I do expect a little bit of a battle, but again, bulls are showing their hands a little bit here.
We don't take moonshots anymore. I just said this in the chat. We only take suborbital trips just beyond the.
Yeah, just 12-minute trips and say we go to space.
We don't take William Shatner trips. What's going on?
I don't want to knock William Shatner.
Not a word. Don't you two dare it. Don't you two do it.
All right.
Don't you do it.
Let's go. Greg, what are your thoughts?
Don't you rip on Captain Kirk today.
My thoughts are all in the Tackle Today blog. I wrote it for today, and I talked about how the intermediate term here, you had the lower lows, you had the lower highs, exactly kind of what Matt just spelled out here. And then I said, you know, we've got some bearish undertones here, but I said, whoa, wait a second. We have a higher low. We have a higher low pivot. So all of a sudden, when you break this down, you go, okay, intermediate wise, yes, we're down, but short term, look at that. We're making a higher high and we're making a higher low. Right. So when you start to get that turn, that doesn't mean you go, hey, you know, let's just dive into the markets and go nuts here. What it means is, okay, now there's a big neon sign saying, pay attention to me. And that's really what I found was most telling about this is today's response. I was looking for exactly, you know, something to that effect. Right. I expected that because we put in that higher low earlier this week, that if we were going to get follow through, and if was the proper term, if we were going to get follow through, we'd need to see it today or tomorrow, and we're getting it today. So I think this is a good positive response, but I 100% agree with Matt. When I look at a reversal, I want to break the falling trend line. I want to break some moving averages, and then I want to break some resistances. Once I get those three things in place, then it becomes a reversal to me. Right now, it looks pretty, but it's really got to follow through for me to get super excited about heading back up to say 45, 50, something like that.
Gotcha.
Right. But I really like the response, the way it's looking right now. And for all the reasons that Matt said, and kind of just how like I said, this is exactly like if you took Matt's words and threw them in the Tackle Today blog, they're almost verbatim to what he said. So yeah, I like the response today.
Good. All right. Well, let's take a look at the rest of the index and see if we like the response on the other ones as well. Here, Matt, let's flash through NASDAQ, Dow, Russell real quick if we can. Then we'll get to commodities. I want to get to stock talk here in a few minutes because earnings roundup really is hot and heavy here today. What are you seeing across these other indexes?
Very similar conversation. You are seeing this as a W formation with an increasing support level that has now dinged to 34,000. Kissing up against the same type of analysis we're looking at in the S&P 500, looking at the 50-day moving average. Ultimately, I do think confirmation does exist above 35,000 on the Dow. That's kind of the number I'm looking at, but you got to like the build of support and the momentum you're seeing today in the Dow Jones. Russell 2000 here. Well, we got the symmetrical triangle break that we've been discussing here on the rut. It was pinching. It was pinching. Upward movements in support, downward movements in resistance. You see the explosiveness one way or the other. Just fortunately for those bulls, that explosive, and the bulls, I mean Tyler, like Tyler's the bull here. But that breakout, you see the nice momentum. And like we talked about yesterday when we were looking at the Russell 2000, a breakout either way of a symmetrical triangle, guys, you got to be looking towards the next level of support. If it would have broke down, I absolutely would have been looking at 2100 as that next level support. Yes, even with 2150, even with 2176, even those support levels. Once you break that symmetrical triangle, I just have a tendency to see these things have a tendency to explode down. You did break out, looking at 2300 as a target. Does it have the opportunity to eventually break out and run again? Man, I feel like I'm a broken record every time the Russell comes up into that 2300 level. It just is nonstop. And I'm going to say it again. Yes, it has a chance. It has a chance. It had a chance. It had a chance. It had a chance. It had a chance. So I'm not going to call a shot by no means. 2300 makes a little bit of sense to me. So let's just stay there on it. And then when you
let me interject
go ahead,
for a second if I can, Matt. This is what we call a game of whack-a-mole. Every time it lifts its head up, bang, it's back down again. I'm calling the shot right now. It's going to do that again at 23.
I wouldn't bet against it.
So I've learned this week that when Tyler's on vacation, Greg and I like to take shots at him. So
that's what are you talking about?
Wait a second, hold on.
I know exactly what just happened.
That is anybody. Anybody. Tyler's just the individual. We got that at tackle. There's a friendship. There's a bond there with all of us coaches. We've been through the muck together a long time. So there's a little bit of that type of talk. And I'm not going to say it's all Greg. I will say it's mostly Greg, though. I will say that.
Hey, I just want to put out there, it wouldn't matter if he's on the show or not. I'm still saying.
Oh, you would say it was here. 100%. We're not saying that.
It's not just because he's on vacation.
Okay. Now, lastly, the concern that we've had recently in the market is in the NASDAQ. But like I said yesterday, it's hard for me to see the S&P reverse and the NASDAQ not reversing. It's a matter of performance following that. Is the NASDAQ going to outperform? Well, to be able to do that, you need to start violating and seeing some momentum that the S&P doesn't have right now. So you would see, you got to like the movement, and you definitely got to like the breakout back up above 15,000 on the intraday. You are absolutely seeing this V-shaped style in terms of, like I said, in the S&P, that's a little head and shoulders type formation. In the NASDAQ, it's more of that V-shaped type technicals where, again, the momentum in a V-shaped recovery, guys, does not matter before the actual reversal. The key point is looking at this support level right here and then watching that momentum build. Right now, you got to appreciate as a bull the momentum build. You got to like it getting back up above 15,000. But again, I'm not seeing anything technically that would tell me that the NASDAQ is coming back in favor against some of the other sectors out there, against some of the other industries out there, when I really just got this is performing as the market is performing here today. Let's see that day where the NASDAQ's up 3%, the S&P's up 1.5%. Like one of those celebratory, everybody's happy days, right? But the NASDAQ is just killing it. And then you can start to see performance come back in. So maybe the NASDAQ catches up. It had a little bit more volatility to the downside. But as of right now, I just see the NASDAQ recovering. And because it has a little bit more negative volatility or bearish volatility in it over the course of the last few weeks, you're just coming from a lower price point, which means your battles, you got a small battle at 15,000. Again, nice little golf clap for winning that battle here today. But that is just a golf clap for me. But again, that's a win here. They were willing to pay above the higher price. You got to like that. But again, you still have not even came into the 50. And the 50 to me is really where the NASDAQ resistance starts to come in. That 15,000 significant whole number, it had a couple data points there over the last couple days. Ding, come down, ding, come down. But, and those two data points are right here. But when you're really looking at it, you're looking at the 50-day moving average. It coincides with this old resistance level really well. That's where I see that battle playing out here. And unfortunately for the NASDAQ, the S&P might be overextended as it does come into that battle. So stay with us, but I still got the NASDAQ underneath the S&P, and I definitely need to see some outperformance to move it in front.
Yeah, and that's a really good point. I was looking at the performance of some of the different components of the S&P and the NASDAQ. It's broad based here on the S&P today. The NASDAQ is obviously in line with market performance, but got to see it play a little bit more catch up and have that big day blow out of the pattern. I like that.
And again, take a look at XLK here. The XLK looks a little bit better than the NASDAQ does, but again, you're looking at that 155 handle right there. You're battling up against it. You got to light the support build from 150 going into the 155. You certainly could see something aggressive above 155 to 160, which would be a very good trading environment given a 5-point movement in a sector. That's a real big movement in individual components of that sector. And so definitely keep an eye on it. And it certainly could outperform. But as of right now, I just got this doing what the market's doing today.
Gotcha. Appreciate the insight there, Coach Matt, on the big picture, broad markets. I do have a couple of quick questions, or maybe just looking for a little bit of analysis just on one specific sector, because I went through all of them today. XLB stood out to me. We highlighted metals over the last few days, gold, the reversal. I put Newmont Mining as one of my picks yesterday for a reason. Love what's going on with copper. Freeport-McMoRan, one of the top performers here today, by the way. And then here we got XLB. Is this a bear stop out day? How are you reading it? And I mean, to me, a lot of strength in the space. No question about that. How do we interpret that here today, Matt? What is your
I never see bear stop out day in a reversal. A bear stop out day is only in a V-shape type reversal.
Okay.
And so bear stop out day, and again, just to make sure because bear stop out is kind of a new way we categorize a breakout against resistance, but I just love how we do that. Remember, this is not bear stop out day.
Because there wasn't a bear setup before this, correct?
That's right. That is just this type of formation. That's all that is. And so you're really talking about the confirmation on the reversal is what you're talking about today. And so, yes, we have been talking about it. We've been talking about $80 being a nice support level. Wait for the breakout. The breakout has occurred. Yeah, but that's just your standardized reversal. Once again, bear stop out day, and I'll give you an example because we're kind of looking at it a little bit on the NASDAQ, but bear stop out day is this type of number where you have a bearish retracement that clearly establishes a resistance level. You have your bearish confirmation, but then it increases support and you see that number.
Gotcha.
And so that's bear stop out day. It's when the bearish retracement gets destroyed. And think about your mentality when your stop loss just got hit in a bullish retracement. Are you looking to trade again?
No, you don't want to make that next
if you just bought a bullish retracement and it just got blasted at support, are you in the right frame of mind to be like, yeah, let's go do it again?
Not 2 days later, I'll tell you that.
And so maybe 2 weeks later. The mentality. Yeah. And think about the bears. Every bear starts getting involved again. Hey, this is our one additional moment we've had in the last 13 years. Well, wait till that just triggers and it comes right back up. And what are they going to complain about? Everything in the world. They're not going to be looking short again. So that's the mentality behind bear stop out day. And I just wanted to describe that. I see this as a W formation reversal. I got the same thing, quite frankly, in the industrial sector as well. You see that W formation with the potential reversal. But coming back to materials, Tim, saw your Newmont Mining pick. Good reversal, fits with the GDX type assessment we've been making, and materials seems to be solidifying itself a little bit. Silver at support, FCX firing off with copper. The miners reclaimed $30 on GDX just last week. We've seen momentum build on top of that. Yeah, it does look like there's a little bit of thirst here for the material space. And again, where you're talking about a day with the S&P, and we're talking about materials here, guys. Materials is not exactly the rock star high-flying areas of the market. A lot of dividend payers there. But when you're talking about the market's up 1.6% today. Here's old basic materials. They decided to do 2.25, outperform the market. And why does that matter? It matters because unlike the S&P, who is now fighting up against the 50-day, here's material saying we don't even care about the 50-day. Let's go.
Let's rock and roll, and they're blasting off. So, all right, very good. Appreciate you answering that question and giving me some insight on that, because that did stand out to me today. Let's flash through the rest of the commodities market if we can here. Crude oil, not much of an update. Either of you can add any analysis you got on it. It's just up at the top, needs to consolidate.
How many times? High base. What do we wait for? Everybody knows. Everybody should know. What do we wait for?
We're waiting for that 9 EMA to catch up.
Mark's girlfriend.
Right.
We gotta wait for Mark's girlfriend to catch up and say hello. That has not occurred. So I still got this within the range, but again, the more time we have within this tight range, we start to build up intraday levels of resistance, intraday levels of resistance. And so again, these time corrections in the market are very important. And a time correction, guys, is basically the technical analysis catches up instead of the price coming down. And so when you're looking at the time correction high base here, give it a more days. The more days you give it, the 9 EMA catches up to it. Look right here, 9 EMA caught up to it. Boom, boom, boom. But again, on day one, you didn't know where that trigger point was. Day two, you didn't know where that trigger point was. Day three, you did. Now we're starting to understand where those hypothetical trigger points will be, and you give it a nice little more couple days, maybe we get a nice little double ding at 82 that gives us a really good clear signal forward.
I like it.
I don't think we know yet. You got some wickety-wick nonsense at the top of this chart. But again, you give it a little more days, those things do solidify themselves.
Especially with that 9 EMA on the daily. And that's where multiple time frame analysis really kicks into gear when you get them both working at the same thing. Love it. All right, real quick one on Bitcoin. One thing I have learned this year about Bitcoin is apparently if you are a governor on the board of our Bank of England, you are supposedly, you have to hate Bitcoin, I guess. I don't know if you saw this report yesterday. Bank of England's talking about interest rates and all this kind of stuff. And then one of the governors basically said, Bitcoin's going to crash the financial markets all the way through, just like 2008.
Hey, Governor I'd like to remind Governor Carney of something. They've had zero interest rate policies for 10 consecutive years. The European debt problem of 2011 was caused by your debt, not because of Bitcoin. Why don't you fix your own house and leave Bitcoin out of your mouth?
Dude, they like talking about Bitcoin.
I got something I'd like to say about. Did he forget that it was the real estate that caused the crash in 2008?
Yeah, it's
nothing to do with
bank,
Bitcoin. Absolutely nothing.
It's central bank vanity and arrogance is what 100%. Crashed the markets in 08 and 09. It's them loosening financial regulations to make sure that bonuses were paid out at the highest level. Had nothing to do with Bitcoin. It just. And again, I'm not sitting here trying to fight for Bitcoin. I'm more like anti-central bank nonsense. But
I would love to have a coffee with Governor Barney or whatever his name is. And
I don't know if it was Carney who said it.
Whoever
Barney?
said it.
Governor Barney.
He's been talking about it for years, by the way. I would just love to have a coffee and be like, do you really understand it? Do you really get it?
I would like to tell me how it works.
How does it work?
If you're having that conversation with him, Tim, he's got to wear the big purple dinosaur suit.
There you go.
While you're having the conversation.
Why not? No chart update on
Cardi,
Bitcoin.
not Barty, but yeah.
Whatever. I'll take the Barty reference. We're moving on. Let's get into stock talk. It's time for earnings roundup. We buried the lead here today. Earnings season's fully into gear. Today is the busiest day of the week so far. Had some names come out yesterday that were significant and important, but today we had some banks. We had some more banks, but we also had healthcare and we had Taiwan Semi. Matt, where do you want to start here?
Well, the one I was looking forward to the most was Domino's today, amazingly. So we will talk about DPZ too, but I want to start a little bit with Taiwan Semiconductor here. And I'll do the banks at the very end because there's 5 or 6 we're just going to rapid fire because a lot of similar numbers, and it really kind of is. Honestly, with the banks today, it's more about the sector than it is any individual component, although we may like different components a little bit more. But I want to start with Taiwan Semiconductor here. Obviously, 110 support level is very well known to all traders and investors of Taiwan Semiconductor. Very anticipated report, and we saw an increase in EPS numbers against last year. They came in at 108 today. The expectation was 105. Good positive beat there. Revenue came in slightly slightly above the expectation at 4.9 billion versus the expectation of 4.8. You also reaffirmed guidance out of Taiwan Semiconductor, and that to me, the reaffirming guidance was I don't want to say it was very important, but I did have a little bit more eyes on that guidance report coming out of Taiwan Semiconductor, given the fact that they've had some additional concern. Obviously, with the supply gut that is happening around the world right now, I think we have, I think it's all over the news now, but like what, 50 shipping containers outside the port of Los Angeles right now, just can't even get them in. Like it's a real situation. And so there was a little bit more anticipation around Taiwan Semi, and especially with some of the recent aggressiveness that China has shown towards Taiwan in general. I just was a little bit more interested, given the geopolitical backdrop and the current economic backdrop, what they said. So the reaffirming of guidance was an important first step in that. There's no trade here. We're talking about long-range neutrality here. But for participants that do like Taiwan Semiconductor, you know, if support holds, you're not going to get a better opportunity, in my opinion, on a company like Taiwan. Now, if support breaks, yeah, all bets are off. You're talking about $90 here, but you got a very, very, very tight range here at 110, 110, 110. You look at that on the weekly chart very quickly, 110, 110, 110. You see that come in. You know, to me, again, it's a company I have some degree of fondness. I'd put it into the top three of most important semiconductor companies in the world. And unlike some of our semiconductor companies, Taiwan spends a tremendous amount on R&D. Let's see the 110 hold. So far, so good. But again, I think the concern here was guidance. They came in. It was a beat and a beat, although slight. It was a beat and a beat. Guidance was reaffirmed. I think that's a positive step in the right direction.
Yeah, I appreciate all the analysis, by the way. I think everybody should have Taiwan at least on a radar, in my opinion, from a long-term perspective. Whatever you do with it right now is a different
one of
question.
our favorite companies.
One of the best companies in the world. It really is one of the best companies in the world, in my opinion. And on the supply chain thing, Matt, actually one of our top stories today in the huddle is going to be on supply chain bottlenecks. The Biden administration is making some moves right now to try to get those ports in LA County, Long Beach up and running. I had no idea how much of the volume those two ports out of Long 40%. Beach and LA, it's huge, you know, so that's going to be the top story in the huddle today. Tune into the huddle at 5 Eastern on that podcast. We'll get you some more detail on that. But all right, Taiwan, I had support.
It's a positive step in the right direction for old Taiwan Semiconductor. Let's move on into the healthcare space, and let's talk a little bit about United Health here. Major component in the healthcare space. Now we're looking at a weekly chart. Let's go down to the daily. Little gap up into resistance, getting fought back down. But let's not get over analyzing that daily chart. There's no trade here, but there could be in the short term. United Health comes in at 452 versus 441. Revenue came in at 72.3 billion versus 71.3 expectation. That resulted in an 11% increase in revenue year over year. Now, so why the explosion here? Number one, their EPS numbers and revenue, they were fine. Okay. But you've heard me say that a lot with earnings so far in the last 2 weeks. We're fine. We're fine. We're not seeing an explosive beat here. The market's not moving up based on, oh, we got a slight beat on EPS and we got a slight beat on revenue. They came in with guidance, and that's what really is you're seeing a little bit of the additional price response and volatility. Headline, increased guidance. That's the headline number. Increase in guidance. Headline number builds into that cash open, doesn't it?
It did build the cash open.
It builds into the cash open. But then the traders
I was just
who are going to actually understand the guidance will have a different perspective.
Correct.
And that's the perspective I want to bring here today, because I'm not going to label them cheaters.
Come on.
But there's a slight beat and a cheat here. Well, that's all I'm going to say. When you increase guidance, but within the range, all you're doing is increasing the support level within a neutral range.
This might be the new form of cheating.
That's all that's happening. Let's keep the top range high. Let's keep that massive expectation same. But let's just say, guys, just hypothetically, let's just say it's not going to be $7.15. Let's just say it's like $7.20. It's still within the range. And so I do understand a little bit of profit taking, especially against the pop on the cash open. The guidance numbers, the headline, the reality is it was upgraded within the ranges though.
Yeah.
And so a little bit of a beat and a beat, got a little pop on the cash open, traders snuffed it out. Let's see how this, and I don't think it's too big of a negative thing, by the way.
No.
Because if United Health now comes, a major component of healthcare, now comes down, but all of a sudden we find support, say right there around that 50-day moving average, I think you could see some things in healthcare, which is starting to show some reversal characteristics in itself as well.
It's attempting that at
so
the bottom.
For me, this is not necessarily about United Health. This is more about the healthcare space in general. It's been under a lot of pressure in recent history. And even though I officially got United Health as a beat, United Health, I think I called them United Health, I think
that might have been something deep down.
Health insurance
companies.
I just wanted to clarify. Wanted to clarify. Even though I do got them as a beat and a slight cheat from a guidance perspective, the positive response, you're seeing that picture come in a little bit more clearly on the healthcare space. And again, underperforming the rest of the broad market here even today, whereas the market is kind of pushing up against resistance channels. You see it at the top of today. Well, why healthcare? Why is healthcare selling off a little bit intraday? Why do we even see a wick on healthcare? Well, you just saw United Health. Yeah. It's selling off, but the stability argument of healthcare is starting to come into light. And as long as we start to see a little stabilization even on United Health with sell-off intraday, I think this is a positive step in the right direction for healthcare.
I agree. And the price response makes sense to me. It deserves to be up a little bit. Did not deserve to have like a 10, 12, 14% runoff.
No.
It gapped up 9%.
No.
Come on. No, it wasn't there. All right. What do we got next, my friend? I appreciate all that.
Look, we're going to save the banks till the very end here. And we're going to go to Domino's Pizza here with some volatility. Domino's coming in and a little bit. Again, Tim, we got to start with one thing. You got to start this earnings season with a beat and a beat. You have to do it. You got to start this earnings season with the beat and the beat. Domino's didn't do that. Domino's comes in slightly above the expectation on EPS, 324 against the 311 expectation. Revenue came in. We're gonna call it in line.
In line,
but it was 2 million short. They came in at 998 million. The expectation was 1 billion. So they came in slightly underneath that expectation. But again, you got to beat and beat here. That did result in a 3.1% yearly increase in revenue from a month-over-month perspective last year. Now, gap down, obviously we start with beat and a beat here. You don't beat, we're not interested. Well, that's why it came down. But I think you got to respect the price response back up here on the intraday. And I think the market has it right. Because I think the number one timeline we have to look at when it comes to this type of deeper retracement in Domino's is that weekly chart here. And when you're looking at this weekly chart, nice level of support is building on that weekly chart. Yep, wickety wick nonsense here. We all understand that given the daily gap down on earnings today, firing back up. Now, you see this little cluster of moving averages right here, the 20 and the 9. I think that's kind of that line in the sand. We're saying we gotta reclaim that. We gotta reclaim that level. Call it 492, 493. Let's see if that looks anything on the intraday. 491 looks like confirmation on the intraday. Then you have just one thing to look at on the daily. Wouldn't be a concern on the weekly, by the way, for those position traders and those swing traders who use multiple time frames. But when you're looking at the daily chart here, that 50-day moving average, that's a frowny face coming down at us. That's going to coincide real nicely with that $500 price point. My point is this. I do see a swing trade here. Swing trade breaks up above the daily chart. First target 500. You're looking at that as consolidation of 500. And then this is an if we can get back above 500, man, we're going to walk up the stairs 520, 540. All of that starts to build on that weekly confirmation. And so I definitely see a trade here, but a lot of it's due to the firing back off response. again, it starts for me on the daily chart at 491. You see the wick over here, 491, 491. Starts for me on the daily chart at 491. Build the 500. Let the battle take over 500. And then ultimately, a lot of traders are going to be looking right here at above 500. A lot of traders will basically say, Matt, I don't care what this does between 480 and 500. Let it do whatever it wants between 480 and 500. Let it consolidate another week. Let it consolidate another 2 weeks. I don't care. I like it above 500, and I would have nothing to say about that. That is good analysis. I'm just saying there is a front running for aggressive swing traders. There's some front running behavior above 491 to 500.
There's a swing trade in there. There is a swing trade in there, but I honestly believe you could even do one of these as kind of the scale in approach, Matt. You know, you scale into a small position, dip your toe, catch it up to the next breakout point, and then you could even add to it when you get the clarity on the weekly chart. And by the way, I loved the analysis you just gave, because it makes a lot of sense to me as to what Domino's did here today. I dug into this report a little bit. Go ahead and finish your thought, though.
And again, look at the cash open. It's all positive. Overnight, that's the miss.
Because they reacted to the number on the miss, right?
Yeah.
Yeah.
Here's the positive. Now you start to see the consolidation right there about 490. I'm just saying 491 because of that wick. It's all within the range there. But again, I do see that. That's a good day trading signal above 490. Day traders hit it above 490. Swing traders hit it above 491. And position traders and investors hit it above 500. Yeah. Seems simple to me.
I agree. And look at the company's reaction to their last earnings report, and go back and look at a 15-year chart. I think you need to be interested at some level in Domino's. And I was actually worried about Domino's because of what was happening with consumers, Matt. In these inflation reports, which we've been covering day by day by day by day, August and September, guess what consumers were doing more of? They were eating at home more, cooking from home more, and offsetting food costs. They weren't buying a lot of delivery stuff. So the fact that Domino's came in line with their revenue, international revenue was actually up, domestic revenue was down, but you had a lot of headwinds that could have been worse here. I still like Domino's. I'm excited about it.
Listen, even in the worst of times, people like pizza. It's cheap.
It's true. Yeah, it's true. And Domino's has shown that it can do well in any market condition.
Domino's isn't exactly like going to, your favorite steakhouse.
No, it's not. It's not.
You know what I mean?
Yeah, it's not. Yeah. It's not. And I'm still just interested in the company. Maybe I'm also hungry for some pizza. I'm not sure.
I think you just might have got me hungry for some
pizza lunch. Yeah. Pizza lunch at Tackle Trading. Let's do it. I think that could be a lot of fun.
Somebody called DoorDash.
That's right. All right, where are we going next?
Now let's do a little rapid fire style in the banks, and we're going to start with Bank of America here today. Bank of America comes in, very good report out of Bank, and again, none of these banks provide guidance. Haven't been doing that since the pandemic. Don't know when they're going to bring it back. So we just got to go off the raw numbers here, but raw numbers very good, very decent for Bank of America, and certainly understand the price response as Bank of America is kissing against yet another breakout here. 85 cents against a backdrop of expectation of 71 cents. Revenue comes in really hot at 24 billion versus 21.7 expectation. That resulted in a 10.7% increase in revenue year over year. I would say very healthy raw numbers coming out of Bank of America. Certainly understand the price response. Technically, everybody sees the resistance level. That's obviously something traders will look at from a trading, but you're looking at this as confirmation on that weekly breakout at this point. Look at the wick all the way down, fighting back up into that breakout. I think it's a positive development on multiple time frames, both the daily chart as well as the weekly chart for Bank of America here post earnings. Wells Fargo, on the other hand, comes in at $1.17 versus 103. Revenue came in not as good as Bank of America. Came in at 19.8 billion. The expectation was 18.5. So officially a beat. But again, we're always going to cross compare against the banks here. Wells Fargo down revenue, down 2.6%. No guidance here. Again, a little bit of a beat and a beat as well. Revenue did not even top year over year status. So a decline in revenue year over year. And we all know it's kind of, I mean, if Wells Fargo versus Bank of America had a Q rating, I think Bank of America would be higher. I would just say that. I'll just throw it out there.
I think we all understand.
Wells Fargo has some imaging problems, I will
Yes.
say.
Yeah.
And so you got to do a little bit better than your counterparts, and Wells Fargo simply didn't do it here today. Morgan Stanley investment bank juggernaut here, a little precursor to the Goldman Sachs report coming tomorrow, and Charles Schwab, by the way, tomorrow as well.
Yeah.
But Morgan Stanley comes out with a 204 versus 170. Nice little EPS beat out of Morgan. Revenue came in hot at 15 billion versus the 13.7. That resulted in a 23% increase in year-over-year revenue. Got to like the report, but again, even with the Bank of America report, you got to like the reports, but it's not going to shock anybody to see banks beat here. Again, don't provide guidance, so we got to look into the kind of the price performance here. You're fighting up against the 50-day moving average, underperforming the rest of your counterparts. Let's see that break up above that 50. But even if it does, you're still staring down the barrel of 105 resistance. I got Morgan Stanley as nothing to see from a trader's perspective. Investors, they're not going to care about this report. They're going to say, yep, Morgan makes money trading. They're fantastic. Keep making money trading. When you're looking at Citibank here, Citibank fighting off that 200-day moving average here. Citibank comes in at 249 versus the expectation of 192. Revenue came in pretty decent at 19.4 billion versus the 17 billion in expectation. That resulted in a 3% yearly increase in revenue. Nice beat on EPS numbers, good beat on revenue numbers. But yet again, revenue only up 3% year over year. Muted response on the earnings. I understand that as well. But again, when you're talking about these banks' earnings, most of the banks reported within the ranges.
Yeah, they did. And they reported within the ranges. The price responses are within the market maker volatility expectations. The Morgan Stanley and the JP Morgan reports this week have me eagerly anticipating Goldman Sachs tomorrow. I am going to tell you that, because even like Morgan Stanley, and I don't want to go too far off on this, but they had very similar commentary to JP Morgan. M&A activity, revenue was up, and their E-Trade acquisition, by the way, a lot of these firms, they were acquiring a lot of those brokerage types. Their net revenues for wealth management was up from that, I believe, 26%. So there's some good stuff in there, but there's some misses too. Goldman's the big one for me, Matt. We're going to close the week on Goldman. Everybody knows Goldman. I know it's the same size as some of these other guys, but I'm eagerly anticipating this one tomorrow. I want to see if they have the same kind of narrative. Did they have trading revenues up and all that kind of stuff, but they also had some other problems. We'll wait and see. All right. Any other earnings roundups?
No, I'm done.
We got it. Thank you, Coach Matt. I know that's a lot of work every day getting us prepared for that, but that is a very, very important part of market understanding. So we appreciate it the whole way. All right. Only a couple other ones here. Give me UPS just while we're in stock talk before we get into the fundamental focus here today. And I'll set Greg up in a minute. This one just stood out to me for a couple reasons. Number one, you highlighted the industrial chart picking itself up, about to push towards a breakout. UPS caught an upgrade today, and it's one of the top performers on the S&P 500 with a lot of relative strength, upgraded to a buy from a hold at Stifel Financial, citing valuation, secular volume growth, a bunch of stuff that they like. Their e-commerce revenues are coming up, so they liked it. They stuck a $224 price target on it as well. Pretty aggressive upgrade, and the stock is looking good. Matt, what about the charts? What do you see there from reversal characteristics?
Well, you got slowing momentum to a certain degree, but again, the pivot relationship is a little bit difficult. So I would have put this as a standard market reversal. I do think you're getting a little bit of additional bump up once you reclaim all the moving averages, and it is reversing. But again, sometimes markets just reverse. I wouldn't have said this is something I would have been looking for. Nonetheless, you got to like the fact that it's breaking back up above all the moving averages. You got to like the fact that once it reclaimed the 50-day moving average, it's holding its head towards the highs there as well. Technically, you're looking at this on the 50-day moving average, old resistance acting as new support. But again, that's a choppy mess in recovery analysis.
Might be a post-earnings situation that we're going to be looking at.
I don't feel like chasing the dragon before the 25th of October here.
Yeah, a little tight there. All right, sounds good. Let's move into our last segment here today, and that's going to be our focus on fundamentals here today, Greg. And are we calling it fundamental focus or focus on fundamentals, Matt? Fundamental focus. All right. Fundamental focus. What we've been doing here every Thursday for the better part of a month now. Coach Greg, we know him. We give him the nickname Old Money Holmes for a reason. The way that he looks at companies, the way that he looks at charts, the way that he digs into data and information. Fundamentals are a very important part of Greg's investment approach, the way he approaches the markets. And so we've invited him onto the halftime report each week to do some teaching and to help somebody, the community out there understand one concept in fundamental analysis better on a weekly basis. Greg, what do you got planned for us here today?
Well, I'm going to take the screen share here if you're good with that.
Yeah, of course.
And, let's see if I can get this to do it right. There we go, FinViz. So today we're going to talk about debt to equity. It's another ratio. We've talked about price to equity. We've talked about price to sales. We've got a bunch of different metrics in the fundamental space here that are really, we're building a picture. We're painting a picture. The essence of fundamentals is you need a picture of what a company looks like from the inner working. So call it a blueprint, call it whatever, a map, whatever you want to call it. The reality is we have to put some things together. And so debt to equity, the one we're going to talk about today, the reason why debt to equity is so important is I want you to think about your own household or think about a nation or, any company for that matter. They're going to use debt for a couple of reasons. Okay. They're going to use debt to run the business sometimes. They're going to use debt to improve the business sometimes. Most businesses have some form of debt. Okay. Whether it's, again, building the business or whether it's just, running the business, there's lots of reasons to have it. The key to debt to equity, the ratio and why it's important is because it gives us an insight into the company's financial leverage. There are companies that are just rock stars with using debt to become better. And then there's companies that get into debt, that get themselves into real trouble. And I'm going to talk about all those things one by one here. But just to break it down, the debt to equity ratio, basically you take the total liabilities of a company and you divide it by shareholder equity, and it comes out to a ratio. Now, the ratio, if you think about that, if you have more liabilities than you have shareholder equity, that could be an issue, right? It's basically shareholder equity for those who are not familiar with it. Shareholder equity is just essentially assets minus your liabilities. That's what it equals, right? So it's a very simple thing. You can go to a balance sheet on yahoo.com. You can go to the balance sheet of any company. You can look at the assets, liabilities. You can minus that, and it gives you your shareholder equity. So these ratios are not hard to figure out, but they are important when you want to see how is the company managing their debt. Their debt can be, like I said, it can be really great, or it can really be problematic all at the same time. It's a double-edged sword. That's kind of the best way I can describe it. Leverage in general, for all you option traders out there, right? Leverage can be great. You could buy yourself a call option. You get a little bit of leverage out of that, and you can do well with putting in a little bit of capital. But in the same vein, you can also lose a lot because that leverage is there. So kind of think about that when you think about this ratio. So when we start to look at this, you can go in and again, the debt to equity ratio is just total liabilities over shareholder equity. It's very simple to figure out. However, we have it even simpler than that. If we look at FinViz here, they actually have the ratio right there for us. Okay, so debt to equity. So debt to equity for Coca-Cola here is 1.89. Well, what does that mean? Well, much like most other metrics, we need to compare that to other companies of a similar nature to understand how they're actually using their debt. Are they using it well? Are they using it poorly? And what does it really mean? So if we get out of this and go to a competitor of Coca-Cola, which Pepsi, we've been doing this for a couple of weeks now, and we go to Pepsi and we kind of look at this. So 1.89 versus 2.33, okay, for their 2.60, I apologize. So you've got a couple of different numbers there, right? Yet you've got very similar companies. So the question comes is, how are they managing their debt? Are these good? Are these bad? Well, again, the higher the ratio, potentially the higher risk to a shareholder. Okay, so just think about that. If a household has more debt, okay, the cost to service that debt can be problematic. Now, If that household is using that debt for a reason, like perhaps to create income or something like that, all of a sudden debt can become very good. Let me give you an example. Amazon is a company that uses debt very, very well. They've went in and let's just look at their number very quickly here, just so you guys can have a kind of just a view of this. But look at their debt to equity ratio. It's 0.59. It's very small, but yet they're a larger company. Now, we can't compare their number exactly to Coca-Cola because the companies are different. But the point being with Amazon is they use their debt very well in the fact that they go out and buy other companies. They buy, Whole Foods and other things like this. They build their business with their debt. That's a good thing. However, if the cost to service the debt is too high, that becomes a bad thing. So when you start to use this metric as a form of comparison, like we did with Pepsi and Coca-Cola, then you could say, okay, the higher the debt, chances are, the higher the debt, the potential higher cost to service that debt. And so it can become problematic. Okay, if it's not a problem and it's used to build more revenue, then that can be a good thing. So you can kind of look at these two different things and kind of look into them. Now, the one thing I want to say is there's a difference between short-term debt and long-term debt. Okay, so when we start to break this down, there's another ratio that's akin to this debt to equity, and it's called the current ratio. What it does is it takes the debt to equity ratio, instead of being total liabilities, what it does is it looks at short-term debt versus long-term debt. Okay, long-term debt can be problematic because it can weigh down the cost of servicing that debt, can weigh down on a company's equity or a company's earnings. So long-term debt can be problematic. So if we go and we look at the current ratio, this gives us a bird's eye view of what, let me get back to Coke and Pepsi here just for our comparison's sake. This can give us an idea of how they're managing their short-term debt versus their long-term debt. So this current ratio, their debt to equity is 1.89. Their current ratio is 1.50. So what that means is their debt, or their long-term debt, is actually quite small when you start to take these numbers. And you can do this individually, but FinViz gives us these numbers very easy, so we can make this a quick process. So basically, if we look at this, 0.39 would be the long-term debt portion of Coca-Cola. So you can quickly look at this and go, okay, it looks like their current ratio is actually pretty good. So they're managing their short-term debt. Now, if we go to look at Pepsi, and again, these are all comparisons that we use. If we go to look at this, we can say, okay, they had a higher debt ratio, but look at their current ratio. Their current ratio is quite a bit smaller, which means a lot of their debt is longer term. So if we take this in a vacuum and we look at this, we can say, okay, it appears that Pepsi has more long-term debt than Coca-Cola. And this can be one factor of many when we look at fundamentals. Ideally, I think anybody could agree that if a business had no debt and yet they were still making revenue versus a company that has debt and is making the same amount of revenue, we would say that one is better than the other. So really the debt to equity ratio is that comparison of, okay, how are they managing the leverage of their debt? And if it gets too big, it can be problematic. If it's in line and it's used for specific reasons to generate revenue, then it can be a good thing. But just comparing the two from a debt to equity ratio can give you another piece of the puzzle when it comes to a fundamental look into a company. So that's your debt to equity ratio. Like I said, there's, I kind of went over the formula there, but we're lucky that we have places like FinViz here, gives it to us very quickly. And again, we can start to build on these building blocks, right? PE ratios, price to sales, price to book, net tangible assets, all these things that we've been talking about each week. We're now adding another block on this to give us a really good fundamental picture.
Very interesting, Greg. And let me ask you one clarifying question just from the conversation. So when you're using debt to equity ratios and analysis, how important is it that you're looking within industry comparisons? Like you did Coke versus Pepsi. I mean, would that also apply to other food companies? Do you like to keep it like specifically when you're looking at a beverage company, look at another beverage company? Like how do you use that when you're comparing like the way you did here today?
Yeah, so it has to be similar businesses, right?
Mm-hmm.
So everything we've talked about in fundamental analysis, I can't compare Berkshire Hathaway and Coca-Cola. I can't. They're two totally separate businesses. One may be very debt laden and it may not be a problem. The other may be, very little debt and it might be a problem, right? So you actually, anything in fundamental, I've yet to find any metrics where you can't compare apples to apples, right? So I picked Coke and Pepsi, and again, I could do this with oil companies like Exxon and Chevron. I could do this with anything that are similar companies because I want to understand, how that ratio affects their business. Okay.
Sure.
And so for this one, Pepsi and Coke, yeah, they have different price levels, but they do the same business. So if one has lots of long-term debt and another one doesn't, and yet they do the same thing and they make similar revenues, then like I said, it just kind of builds that picture up to say, okay, maybe they don't manage their debt quite as well as the other one that's in a similar business. Okay. Now again, you can't do this standalone. Like I would never just buy one company on a debt to equity ratio, but it's definitely something I'm going to consider because when I look at valuating a company, any company, I need to know, okay, are they carrying too much debt? Is that going to affect them in a business downturn? And a lot of the numbers that we talk about here and we have for the last few weeks here, it's only if the business has a problem where these become glaringly obvious. And this is probably, so far of the ones we've talked about, this is the most glaring when things get bad. If revenues start to fall and they're carrying this debt, a lot of that revenue, a lot of that earnings and equity, that's going to have to pay for that long-term debt. And it's not like they can just go, okay, well, we're just not going to do that. So it's these, when we look at fundamentals, I'm looking at something because I expect to hold it, longer than a swing trade, longer than a position trade. This is more of an investment. So I want to know how will they fare during an economic downturn or a business downturn, and that debt to equity ratio is a very important one for that reason.
Appreciate it, Greg, and appreciate this segment each and every week. I really believe that it's helping a lot of people out there that may not have fundamental training yet. So love it, Matt. Any thoughts on fundamental focus here today?
No, debt to equity is one of those ratios that helps us understand how a company is ran. How are they utilizing debt? And quite frankly, do they have the ability to bring in more capital from a debt perspective to invest in the future? And so I think cross comparison of using debt to equity in terms of like companies is a very valuable metric. And Greg, once again, thank you.
Thank you very much. All right, guys, let's start wrapping up the show here today. Another fun one, very important one in the market from an update perspective. We had earnings, we have a technical update, got a lot going on out there. S&P 500, final thoughts. Let's just start with you, Matt. What do you got for the team out there?
Well, we've been talking all day about it, the build that the market is having. And if you look at the market, it's still stabilizing at the top end of its chart. Support's building at 44.20 and resistance is building right there at about 44.25, 44.27 from an intraday perspective. So again, coming into the middle of the market here, the last hour, seen some stabilization at the top end of the chart. I haven't seen the sellers come out to play yet.
They're not there right now. Not yet. Now, you might get a little profit taking the end of the day. There's still obviously technical levels we're paying attention to, but the buyers have been in charge all day long, no doubt in my mind. Greg, final thoughts from you.
Yeah, it's similar to what I wrote in the Tackle Today blog. We're seeing some good things here. We need to see a little bit more follow through before we get super excited. But I again, love the price response. Exercise your patience, but be ready, right? If we get that break of that 50 and we get that break of that 44.30 level, hey, we could be off to the races, and it's something to get interested in for sure.
Very good. All right, a couple quick things for everybody out there. Great show here today from a team perspective. You guys' engagement, your conversation was always lively, and it's awesome here today as always. I love the viewership here today. If you're brand new to the channel, you've not done it yet, click that subscribe button, click the bell. And if you've watched enough content from Tackle Trading to want to join our community, which you should, we're here to help you. We're here to teach you. We're here to train you and welcome them in to what we do on the back end on the pro membership. I dropped a link to the 15-day trial. So if you're looking for a trading community, come and join us. Nothing really to risk here. 15 days on us to try all of the things we do in pro membership. Tonight, we have Cash Flow Club. 8:30 p.m. Eastern. Learn from the great coach Gino. Tomorrow night, ladies, I want to give a day's advance on this one so you can mark your calendar. Women in Trading Mastermind Group. Coach Emily has asked me to remind everybody out there to come and join her, as you guys always do, on a monthly basis. Wonderful job out there today, guys. Appreciate everybody. Appreciate you, Matt. Appreciate you, Greg. Till tomorrow, we'll see you guys on the other side. Have a wonderful rest of your day.